Most people make money feel more complicated than it needs to be. They think wealth requires secret strategies, perfect timing, hot stock tips, complex charts, or some financial genius whispering in their ear. They imagine investing as a mysterious game reserved for Wall Street professionals, math experts, and people who spend all day watching the market. But J.L. Collins, in The Simple Path to Wealth, delivers a much calmer and more powerful message. Building wealth does not have to be complicated. In fact, the more complicated it becomes, the more likely you are to get distracted, confused, and separated from your money. This book began as a series of letters Collins wrote to his daughter. He wanted to give her a simple financial roadmap because she did not want to spend her life obsessing over investments. She wanted freedom, security, and options, without becoming a finance nerd. And that is what makes the book so useful. It is not about becoming the smartest person in the room. It is about building a life where money becomes your servant, not your master. The core message is beautifully simple. Spend less than you earn. Invest the surplus. Avoid debt. Let time and compounding do the heavy lifting. That is the simple path. Not flashy, not dramatic, not exciting in the short term, but incredibly powerful over a lifetime. The monk, the minister, and the meaning of freedom. Collins opens with a memorable story. Two old friends meet after many years. One has become a minister to the king. The other has become a humble monk. The minister looks at the monk's simple life and says, "If you could learn to cater to the king, you wouldn't have to live on rice and beans." The monk replies, "If you could learn to live on rice and beans, you wouldn't have to cater to the king." That short exchange captures one of the deepest ideas in the book. The less you need, the more free you become. Financial independence is not only about having more money, it is also about needing less money to live well. If your lifestyle requires constant spending, status, upgrades, and approval, then even a high income may not make you free. You will always need the next paycheck, the next raise, the next bonus, the next deal. But if you can live well below your means, everything changes. You create surplus. Surplus becomes investments. Investments become freedom. Freedom becomes options. And options are the real prize. Collins often talks about having FU money. Not because the phrase is elegant, but because the feeling is powerful. It means having enough financial strength to walk away from situations that do not serve you. A toxic boss, a bad job, a desperate client, a lifestyle you never chose, a life built around fear instead of freedom. That is what wealth really buys: control over your life. Money. Master it, or it masters you. One of Collins's clearest warnings is this: if you master money, it becomes a wonderful servant. If you do not, it becomes your master. This is the quiet truth many people do not want to face. Money affects where you live, what work you accept, how much stress you carry, how you spend your time, and how many choices you have. When you have no savings and lots of debt, money controls you. You may have to stay in a job you dislike. You may avoid taking risks. You may feel trapped by monthly payments. You may constantly worry about emergencies. But when you save, invest, and avoid debt, your relationship with money changes. You are no longer chasing it just to survive. You are using it to build a life with more independence. This is why Collins's approach is not just financial, it is emotional. He is not simply teaching how to invest. He is teaching how to remove fear from your life. Can ordinary people become millionaires? Collins believes that many middle-class earners can become millionaires, not because everyone will become a superstar entrepreneur, not because everyone will pick the perfect stock, not because everyone will get lucky, but because compounding is powerful. He gives a simple historical example. Money invested in the broad stock market over long periods has grown dramatically, even through crashes, recessions, fear, inflation, and chaos. That is the part many people miss. The stock market is not smooth. It does not go up in a straight line. It can crash hard. It can make you feel foolish. It can scare you out at exactly the wrong time. But over long periods, productive businesses tend to grow. And when you own a broad index fund, you own a slice of that growth. So why does everyone not retire wealthy? Collins gives a blunt answer. Because many people do not live below their means, do not invest consistently, and do not stay the course. They spend what they earn. They borrow to buy things they cannot afford. They panic during downturns. They chase trends. They make money complicated. They interrupt compounding before it has time to work. The path is simple, but simple does not mean easy. The mantra: spend less, invest the surplus, avoid debt. The book's core formula can be summarized in one sentence: spend less than you earn, invest the surplus, and avoid debt. This is not a cute slogan. It is the foundation of financial independence. Spend less than you earn. This is where freedom begins. If you spend every dollar you make, you have no fuel for wealth. It does not matter how high your income is. If your lifestyle consumes everything, you are still stuck. A high income with high spending can still create financial anxiety, but even a modest income with disciplined saving can create freedom over time. Invest the surplus. Saving alone is not enough. Cash is useful for emergencies and short-term needs, but long-term wealth usually requires owning assets that grow. For Collins, the simplest and strongest vehicle is a broad stock market index fund. You do not need to pick winning companies. You do not need to time the market. You do not need to outsmart Wall Street. You simply buy the market and let capitalism work for you. Avoid debt. Debt is the enemy of freedom because it turns your future income into payment for past decisions. A loan may feel like access, but it often becomes a chain. Collins is especially firm on consumer debt. If you borrow to buy things that lose value, you are moving away from wealth. The goal is not to look rich. The goal is to become free. Think about money as what it can earn. One of the strongest mindset shifts in the book is learning to see money not only as something you can spend, but as something that can earn. Many people look at $20,000 and think, what can I buy? A car, a vacation, a renovation, a lifestyle upgrade. Collins wants you to ask a different question. What can this money become if I invest it? That shift changes everything. A purchase gives you immediate pleasure. An investment gives you future power. This does not mean you should never spend money. Life is meant to be lived, but every major purchase has an opportunity cost. If you spend $20,000 on a car, you are not only losing $20,000, you are also losing what that $20,000 could have earned if it had been invested for years or decades. That is the hidden cost most people ignore. Money spent is gone. Money invested can keep working. Debt makes everything more expensive. Collins's view on debt is simple. Avoid it whenever possible. Take the example of buying a car. If a car costs $20,000 and you pay cash, that is already a major expense. But if you borrow money to buy it, you are choosing to pay even more through interest. In other words, you are saying, I cannot afford this today, so I will make it cost more tomorrow. That is the danger of debt. It makes expensive things more expensive. It reduces flexibility. It adds stress. It forces your future self to pay for your present self's choices. And the more debt you carry, the harder it becomes to invest. Because instead of sending money into assets, you send money to lenders. This is why avoiding debt is not just a financial rule. It is a freedom rule. The stock market is the great wealth-building machine. Collins calls the stock market one of the most powerful wealth-building tools available. But he does not pretend it is comfortable. The market will rise. The market will fall. There will be crashes. There will be terrifying headlines. There will be experts predicting disaster. There will be moments when selling feels like the only safe move. But Collins's advice is clear. Stay the course. The problem is not that the market fluctuates. The problem is that investors panic when it fluctuates. People sell when prices fall because fear takes over. Then they wait too long to get back in. By the time they feel safe again, the market has often recovered. Collins experienced this himself during the 1987 crash. He held on for a while, then sold near the bottom, then bought back in after the market had recovered. That mistake cost him money and taught him a lesson he never forgot. Market timing is incredibly hard because you have to be right twice. You must know when to get out. Then you must know when to get back in. Most people cannot do that consistently. So the better strategy is simple. Invest broadly. Hold for the long term. Ignore the noise. Why index funds are the simple path. The center of Collins's investing strategy is the index fund. An index fund does not try to pick the best stocks. It owns a broad collection of stocks, often representing the entire market. That means instead of betting on one company, you own tiny pieces of many companies. This gives you diversification, simplicity, and low cost. Collins especially favors broad total stock market index funds because they let you benefit from the growth of the overall economy. His preferred example is VTSAX, Vanguard's Total Stock Market Index Fund. The reason is simple. If you own the whole market, you do not need to guess which company will win. Some companies will fail, some will stagnate, some will grow massively. The index captures the overall result. This is powerful because the market naturally removes weak companies and rewards stronger ones over time. You do not have to personally pick every winner. The index does the heavy lifting. Complexity is often the enemy. A major theme in the book is that Wall Street profits from making investing seem complicated. If investing feels confusing, you may feel like you need advisors, managers, expensive funds, complex products, or expert predictions. But Collins argues that complexity often benefits the people selling financial products more than the people buying them. The more complicated an investment is, the more cautious you should be. Simple is not stupid. Simple can be powerful. A low-cost index fund may look boring compared to hedge funds, private deals, market timing systems, and hot stock tips. But boring can be beautiful when it works. The goal is not to impress people with complexity. The goal is to build wealth. The 3 questions every investor must ask. Before building your investment plan, Collins says you need to understand your own situation. Ask yourself 3 questions. 1. What stage are you in? Are you in the wealth accumulation stage, where you are still building wealth? Or are you in the wealth preservation stage, where you already have wealth and want to protect it? Younger investors with decades ahead can often handle more volatility because they have time to recover and keep investing through downturns. People closer to retirement may want more stability. 2. What level of risk can you handle? Risk is not only mathematical, it is emotional. A portfolio may look great on paper, but if you panic and sell during a crash, it does not work for you. The best portfolio is not the one with the highest theoretical return. It is the one you can actually stick with. 3. What is your time horizon? If you need money soon, it should not be heavily exposed to the stock market. But if your time horizon is decades, short-term market swings become less important. Time is what allows compounding to work. The 3 tools: stocks, bonds, and cash. Collins keeps investing simple with 3 tools: stocks, bonds, and cash. Stocks. Stocks are the main wealth-building engine. When you buy stocks, you own pieces of companies. As companies grow and generate profits, shareholders can benefit. Stocks are volatile, but over long periods, they offer strong growth potential. Bonds. Bonds are more stable than stocks. When you buy a bond, you are essentially lending money. Bonds can reduce volatility and help preserve wealth, especially for investors who are closer to financial independence or retirement. Collins often points to broad bond index funds like VBTLX, Vanguard, Total Bond Market Index Fund. Cash is for emergencies and daily needs. Cash does not build wealth well over long periods because inflation can reduce its value. But it gives safety, flexibility, and peace of mind. You do not want to be forced to sell investments during a market crash just because you need money for an emergency. Cash is your buffer. The wealth accumulation portfolio. For people still building wealth, Collins recommends a simple, aggressive approach. Put most or even all of your long-term investment money into a broad total stock market index fund. This approach is volatile but powerful. It works best for investors with long time horizons, steady income, and the emotional strength to keep investing during market crashes. The idea is simple. Keep buying, keep holding. Ignore the noise. Let compounding work. This is especially useful for people who do not want to spend their lives thinking about investments. Set the system. Feed the system. Trust the system. The wealth preservation portfolio. Once you have built wealth, the goal changes. You are no longer only trying to grow aggressively. You also want to protect what you have. That is where bonds and cash become more important. Collins describes a preservation-style portfolio that includes mostly stocks, some bonds, and a small amount of cash. For example, someone might hold a large portion in total stock market index funds, a smaller portion in total bond market index funds, a small cash reserve for flexibility and emergencies. The exact allocation depends on your risk tolerance, age, goals, and financial situation. The key is that your portfolio should match your life stage. Accumulation is about building. Preservation is about protecting. The 4% rule and financial independence. Collins defines financial independence as reaching the point where you can live on about 4% of your net worth per year. This is commonly known as the 4% rule. For example, if you need $40,000 per year to live, you would need roughly $1 million invested. Why? Because 4% of $1 million is $40,000. This rule is not magic and it is not a guarantee, but it gives you a useful target. It also reveals something important. Your spending controls your freedom number. If you need $100,000 per year to live, financial independence requires far more money. If you can live happily on $30,000 or $40,000 per year, the target becomes much more reachable. That is why lifestyle matters so much. The less you need, the sooner you are free. How to apply the simple path to wealth. The practical application of this book is straightforward. First, get out of debt, especially consumer debt. Debt slows everything down. Second, create a gap between your income and spending. The bigger the gap, the faster your wealth grows. Third, invest the surplus consistently. Use broad, low-cost index funds instead of trying to pick individual stocks or time the market. Fourth, stay invested through market crashes. Expect volatility. Do not treat every downturn as a surprise. The market will fall sometimes. That is part of the game. Fifth, adjust your portfolio as your life changes. When you are building wealth, stocks may be your main engine. When you are preserving wealth, bonds and cash may play a larger role. Sixth, remember what the money is for. The goal is not to die with the biggest account balance. The goal is freedom, options, peace, and a life you actually enjoy. Final takeaway. The path is simple, but you must walk it. The simple path to wealth is powerful because it removes the fog. You do not need complicated investment strategies. You do not need to predict the market. You do not need to pay expensive managers. You do not need to chase the next hot stock. You need discipline. Spend less than you earn. Avoid debt. Invest the surplus. Use broad, low-cost index funds. Stay the course. Let compounding work. Build toward the day when your money gives you choices. That is the simple path. And maybe the most beautiful part is that this path does not require you to become obsessed with money. It allows you to think about money less. Because once your system is simple, you can focus on living. You can focus on family, work, creativity, travel, health, learning, and whatever else matters to you. So here is the challenge. Look at your financial life today and ask one honest question. Am I making money my servant, or am I letting it become my master? Then take one step. Pay down a debt. Increase your savings rate. Open an investment account. Buy a broad index fund. Stop trying to time the market. Simplify your plan. Because wealth is not built by people who know every financial trick. It is built by people who follow simple principles long enough for those principles to compound. And if you stay on the path, one day you may wake up and realize something amazing. You are no longer working only for money. Your money is finally working for you.